Okay, Forex Militia, these are the next three rules from the ebook High Probability Trading Setups for the Currency Market, read by Mia. Okay, Mia, take it away.
4. Trigger fundamentally, enter and exit tech. Nicely. Should you trade based upon fundamentals or technicals? This is the $64 million question that traders have debated for decades, and will probably continue to debate for decades to come. Technicals are based on forecasting the future using past price action. Fundamentals, on the other hand, incorporate economic and political news to determine the future value of the currency pair. The question of which is better is far more difficult to answer. We have often seen fundamental factors rapidly shift the technical outlook, or technical factors explain a price move that fundamentals cannot. So our answer to the question is to use both. We know all too well that both are important and have a hand in impacting price action. The real key, however, is to understand the benefit of each style and to know when to use each discipline. Fundamentals are good at dictating the broad themes in the market, while technicals are useful for identifying specific entry and exit levels. Fundamentals do not change in the blink of an eye. In the currency markets, fundamental themes can last for weeks, months, and even years. For example, one of the biggest stories of 2005 was the US Federal Reserve's aggressive interest rate tightening cycle. In the middle of 2004, the Federal Reserve began increasing interest rates by quarter-point increments. They let the market know very early on that they were going to be engaging in a long period of tightening, and as promised, they increased interest rates by 200 basis points in 2005. This policy created an extremely dollar-bullish environment in the market that lasted for the entire year. Against the Japanese yen, whose central bank held rates steady at zero throughout 2005, the dollar appreciated 19% from its lowest to highest levels. US dollar to Japanese yen was in a very strong uptrend throughout the year, but even so, there were plenty of retraces along the way. These pullbacks were perfect opportunities for traders to combine technicals with fundamentals to enter the trade at an opportune moment. Fundamentally, we knew that we were in a very dollar-positive environment, therefore technically, we looked for opportunities to buy on dips rather than sell on rallies. A perfect example was the rally from 101.70 to 113.70. The retracement paused right at the 38.2% Fibonacci support, which would have been a great entry point, and a clear example of a trade that was based upon fundamentals, but looked for entry and exit points based upon technicals. In the US dollar to Japanese yen trade, trying to pick tops or bottoms during that time would have been difficult. However, with the bull trend so dominant, the far easier and smarter trade was to look for technical opportunities to go with the fundamental theme and trading with the market trend rather than to trying to fade it.
Okay, so number 4, trigger fundamentally, enter and exit technically. Okay, so for this rule, you have to think about it like this. What type of trader are you? Are you a scalper? Are you a day trader? Are you a swing trader, or are you a position trader? Alright, so depending on which type of trader that you are, this rule will be off or on, because a scalper who is in a trade for seconds to minutes really doesn't necessarily need fundamental analysis. All they really need is technical analysis. So goes also for the day trader. They don't really need, because they're in from basically hours to maybe a day, and fundamental may help, but it's not very necessary. Okay, but for a swing trader, a position trader, for a swing trader or a position trader, this fundamental analysis may come in very handy. And of course, where I get my technicals is from Forex Factory. All right, you get tons, and I mean, this is like the site where a lot of people basically get their fundamentals from. But you can get it from anywhere. It's and there are so many forex sites, so and they will give you the news. It's on FX Book, it's on FX Blue. So, but this is the site. This is where I started. I felt most comfortable, and that basically is my commentary on trigger fundamentally, enter and exit technically. Okay, let's get on to number 5.
5. Always pair strong with weak. Every baseball fan has a favorite team that he knows well. The true fan knows who the team can easily beat, who they will probably lose against, and who poses a big challenge. Placing a gentleman's bet on the game, the baseball fan knows the best chance for success occurs against a much weaker opponent. Although we are talking about baseball, the logic holds true for any contest. When a strong army is positioned against a weak army, the odds are heavily skewed toward the strong army winning. This is the way we have to approach trading. When we trade currencies, we are always dealing in pairs. Every trade involves buying one currency and shorting another. So the implicit bet is that one currency will beat out the other. If this is the way the FX market is structured, then the highest probability trade will be to pair a strong currency with a weak currency. Fortunately, in the currency market we deal with countries whose economic outlooks do not change instantaneously. Economic data from the most actively traded currencies are released every single day, and they act as a scorecard for each country. The more positive the reports, the better or stronger a country is doing. On the flip side, the more negative reports, the weaker the country is performing. Pairing a strong currency with a weak currency has much deeper ramifications than just the data itself. Each strong report gives a better reason for the central bank to increase interest rates, which in turn would increase the yield of the currency. In contrast, the weaker the economic data, the less flexibility a country's central bank has in raising interest rates, and in some instances, if the data comes in extremely weak, the central bank may even consider lowering interest rates. The future path of interest rates is one of the biggest drivers of the currency market, because it increases the yield and attractiveness of a country's currency. In addition to looking at how data is stacking up, an easier way to pair strong with weak may be to compare the current interest rate trajectory for a currency. For example, euro to pound sterling, which is traditionally a very range-bound currency pair, broke out in the first quarter of 2006. The breakout occurred to the upside because Europe was just beginning to raise interest rates as economic growth was improving. On the flip side, the UK raised interest rates throughout 2004 and the early part of 2005 and ended its tightening cycle long ago. In fact, UK officials lowered interest rates in August of 2005 and were looking to lower them again following weak economic data. The sharp contrasts in what each country was doing with interest rates forced the euro to pound sterling materially higher, and even turned the traditionally range-bound euro to pound sterling into a mildly trending currency pair for a few months. The shift was easily anticipated, making euro to pound sterling a clear trade based upon pairing a strong currency with a weak currency. Because strength and weakness can last for some time as economic trends evolve, pairing the strong with the weak currency is one of the better ways for traders to gain an edge in the currency market.
Okay, for number 5, always pair strong with weak. This builds on number 4, basically the fundamentals. Okay, so what in the fundamentals we are looking for a good employment number, a good GDP number, good CPI, good interest rates. If all that is raising and you see the economy of a country be, gaining in demand because of its economy, then that is most likely going to be a strong currency. All right, so we're always looking to pair a strong currency with a weak currency. Okay, so what I use is a currency strength meter, and you can get this on FX Blue. They also have indicators for MT4 that you can just affix to your platform. But I just use this, and this is pretty decent. All right, so what you're going to be looking for is something like this: the CAD against the yen, the pound against the Swissy, the Aussie against the euro. All right, and you're also going to want to look for a risk on, risk off bias in the market. Now, there are currencies that basically are safe havens and are risk on and risk off. The CAD, the Aussie, and the Kiwi, and sometimes the pound, right, are risk on currencies. The dollar, the Swissy, and the yen, and sometimes the euro are safe haven currencies. Okay. Also, they have gold here. Gold is usually a risk off, risk on commodity. My bad, commodity. So basically, when the dollar and the Swissy and the yen, when people are looking for a safe haven, they are usually also going to go into gold. But it is when it's risk on. I'm sorry, I think I have that backwards. No, they will go into the commodity when it's risk on. I might have to cut that. Okay. Gold as a commodity is risk off. People flood into gold as a safe haven to basically when the dollar and the safe havens aren't looking so good, but they will definitely flood into gold as a means to protect their wealth. Okay, so just look for the CAD, the Aussie, the Kiwi, and the pound risk on, and the dollar, the Swissy, the yen, and the euro as risk off. Okay, and I believe with that we will go on to, that's my commentary number 5. Let's go on to number 6.
Six, being right but being early simply means that you are wrong. There is a great Richard Pryor routine in which the comic lectures the audience that the only way to reply when caught cheating red-handed by one's spouse is by calmly stating, "Who are you going to believe? Me? Or your lying eyes?" While this line always gets a huge laugh from the crowd, many traders unfortunately take this advice to heart. The fact of the matter is that eyes do not lie. If a trader is short a currency pair, and the price action moves against him, relentlessly rising higher, the trader is wrong and needs to admit that fact, sooner rather than later. In FX, trends can last far longer than seem reasonable. For example, in 2004 the euro to US dollar kept rallying, rising from a low of 1.2000 all the way to 1.3600 over a period of just 2 months. Traders looking at the fundamentals of the two currencies could not understand the reasons behind the move since all signs pointed to dollar strength. True enough, the US was running a record trade deficit, but it was also attracting capital from Asia to offset the shortfall. In addition, US economic growth was blazing in comparison to the Eurozone. US GDP was growing at a better than 3.5% annual rate compared to barely 1% in the Eurozone. The Fed had even started to raise rates, equalizing the interest rate differential between the euro and the greenback. Furthermore, the extremely high exchange rate of the euro was strangling European exports, the one sector of the Eurozone economy critical to economic growth. As a result, US unemployment rates kept falling, from 5.7 to 5.2%, while German unemployment was reaching post-World War highs, printing in the double digits. In short, dollar bulls had many good reasons to sell the euro to US dollar, yet the currency pair kept rallying. Eventually, the euro to US dollar did turn around, retracing the whole 2004 rally to reach a low of 1.1730 in late 2005. But imagine a trader shorting the pair at 1.3000. Could he or she have withstood the pressure of having a 600-point move against a position? Worse yet, imagine someone who was short at 1.2500 in the fall of 2004. Could that trader have taken the pain of being 1,100 points in drawdown? The irony of the matter is that both of those traders would have profited in the end. They were right, but they were early. Yet in currency markets, unlike in horseshoes, close is not good enough. The FX market is highly leveraged, with default margins set at 100:1. Even if the two traders above used far more conservative leverage of hours minutes 10:1, the drawdown to their accounts would have been 46% and 88%, respectively. In FX, successful directional trades not only need to be right in analysis, they need to be right in timing as well. That's why believing your lying eyes is crucial to successful trading. If the price action moves against you, even if the reasons for your trade remain valid, trust your eyes, respect the market, and take a modest stop. In the currency market, being right and being early is the same thing as being wrong.
Alright, so on this rule, this is pretty basic, and as you might have seen, the idea is don't try to have a conceived notion of where the market is, what the market is basically going to do. Like I try to do on this channel, we basically have a strategy, an edge against the market that we have tested, we have back tested, and that we know will give us profit. So don't try to figure out and say, well, I pretty much decide that I want to trade the market now because I know my strategy looks good, and before this bar candle, I want to try to get a better entry. Okay, now once again, what they are talking about on here looks more like a swing trading or a position trading strategy. So that basically is that. Let me just go to the chart real quick and just give you a little quick look at, basically what I'm talking about. Okay, so the basic idea is this. You don't want to try to get in on a candle that's, somewhere over here. No, you're going to wait till this basically hits down here at the bottom and possibly comes out. You don't have to, the idea is not to try to, anticipate what the market is basically going to do. Wait for your trade setup. Wait for it to be valid, a valid trade setup, and then take it. So that way that you're not gambling. We're not gambling here. We're not flipping a coin. We have a proven edge. And at the end of it, use a modest stop. Use a stop. Okay? So basically that's it for this episode, this video, these three. And once again, I want to ask you to subscribe and to leave a comment in the bottom, basically telling me what are some of the rules that you use. Also, I do want you to take a look at TradeMiner, which is a software that I am promoting. And with that, I will say, knowledge is power. Be power hungry, and power to the people. This is Parsival, signing out.